Joining me in a rare and exclusive interview is Boaz Weinstein. He's the founder and CIO of Saba Capital Management, made famous perhaps for the London whale, but now bringing a new activist campaign to BlackRock, which is a fascinating new development in terms of going after their closed-end funds. You've made a strategy of going after closed-end funds now for several years. A lot of folks may not understand what a closed-end fund is. So before we even maybe get into the conversation about what is it that you're trying to do and going after the governance of BlackRock, a firm that's made its name in large part on the back of governance and governance issues, what are you trying to do with BlackRock?
Right. So closed-end funds they've been around for more than a century. A lot of the viewers will recognize the Grayscale Bitcoin Trust as a very famous closed-end fund. It was at a discount for years, a very deep discount. And when it converted into an ETF, the discount disappeared. Investors made something like 80 or 90% from that discount going away. On the New York and London stock exchanges, there are over 700 of these closed-end funds. They're portfolios of assets managed by venerable managers like BlackRock. And sometimes, unlike ETFs, unlike mutual funds, they trade at deep discounts to their objective value. And that discount can be corrected with the press of a button, and that's what we're here to do.
So just let's go into why do closed-end funds, as a matter of practice, seem to run at a discount? They trade at a discount almost across the board.
Right. So there are periods when they're at discounts, and in fact, there are many today that are at premium. But why do the BlackRock ones trade at discounts, and why in general do they? It's because there isn't really a sophisticated investor base who wants to own these products. They have high fees. And so at fair value, you could say, I'd rather be in an ETF that does the exact same thing. So I'm not going to buy it unless it's at a discount. And until it gets to double-digit discounts, there aren't really investors like myself that will take up the effort of buying them.
Okay, but what is it exactly that's your problem with BlackRock specifically? And you have been at war, dare I say, with BlackRock now for several years. And you've gone to court with them, too.
Successfully, yes. We won in federal court in December. One of the things we were at war with was that they were violating the Investment Company Act, the sacred 1940 Act, that they prevented us from voting all of our shares, even though the Company Act says every share gets to vote. And in federal court, on summary judgment, the judge said, Saba wins, BlackRock cannot do that anymore. So that was one thing. Our issue is not really about performance, though some of these funds have performed terribly, to use a technical word. In the last 3 years, 9 of the 10 funds that we're even talking about have lost money for investors, negative total return, 9 of these funds. Performance is one thing, but the performance is exacerbated by this discount because a dollar of stuff, whether it's IBM or Bitcoin or municipal bonds that BlackRock manages, despite their $10 trillion in their brand, a dollar of stuff is trading freely for 85 cents, 83 cents, 86 cents in the dollar. And our problem is that having become the largest shareholder in many of these funds, they're actually blocking us from speaking to shareholders. And ISS last year called them out and withheld on their nominees for what ISS termed abusive corporate governance practice.
Let me ask you this, though. Some critics would say, look, the closed-end fund is sold as a closed-end fund, meaning they raise money in the beginning, and the plan is for you to hold it for 12 years, and at the end of the 12 years, you get your money back and hopefully more than that. And yes, it may trade at a discount in between, but that's what it is. And that you, dear sir, are hijacking the process by saying, actually, no, the product shouldn't be this, it should be something else.
Right. So first, most of the funds that they have over 70, are forever funds. They're not 12-year funds. It's only recently that they've kind of tried to split the difference and make it have a term to it. So this idea that a fund that started as one thing needs to be that thing 9 years later, first of all, we don't have a plan to convert it from a closed-end fund into an open-ended fund necessarily. In the last decade, we've done this about 60 times, most of the time to get rid of this overhang of too many people wanting to sell it at a discount. The manager goes and buys back those shares. They tender for shares at net asset value. And investors who want to come out. The ones who want to stay can stay in their closed-end fund for 100 years if they want. And often that does get rid of the discount. There was a Neuberger Berman fund that did that, and they are trading today, NHS, at a premium after doing a tender.
How much money do you think is on the table here if you're successful for shareholders?
That's what's wild about this, because traditionally these were small funds, but BlackRock does everything in supersize. These 10 funds that we've nominated people to the board of, if BlackRock pressed a button, like we've done before 6 dozen times, and allowed investors to get out just at fair value. They don't have to be right about where AMC is going to trade tomorrow. They don't have to be right about the Fed. If it just traded at net asset value, the number is staggering, Andrew. It's $1.4 billion.
I want to read you a statement from BlackRock. Obviously, they are not happy about your efforts to try to upend these funds. This is what BlackRock has to say about all this, and maybe you can react to it. They say that BlackRock has a 30-year history of managing closed-end funds for millions of Americans, American retirees, I should say, who they say depend on them for income. Saba is not a champion for the retail investor, but an activist hedge fund, they say, looking to arbitrage funds in order to capture quick profits. This attack is not about governance, performance, or discounts, which narrow over time. It's about executing Saba's well-known playbook, they say, buying controlling positions and forcing short-term changes that harm retail investors to benefit Saba and its hedge fund investors.
There isn't one word, first of all, there isn't one word that they said that's at all accurate. The retail investor benefits exactly the same way as Saba. We haven't achieved some return and we leave everyone else high and dry. The retail investors are some of the least sophisticated investors in the world. The president of BlackRock, I sat in his office, Rob Capito's office, 7 years ago, and he said, kid, and I was 43 at the time, he said, kid, these products are sold, not bought, meaning no one calls their broker and says, get me the latest BlackRock fund. It is pushed on them by their financial advisor. It has slightly higher fees than it should. It has this super long, maybe perpetual term, which BlackRock loves because they get to manage the money forever. And so the idea that the retail investor is relying on funds where, ironically, we're here in a bull market, Andrew. I don't know if you looked at the stock market. These 9 funds are down over the last 3 years. Total return is down, some of them as much as 54%. And so this idea that the shareholder, which all we want to do is vote. We don't want to decide the matter. We just want to be able to vote. The idea that the shareholder needs these funds when there's an infinite number of mutual funds and ETFs with very low fees that BlackRock manages, by the way, the idea that that is not something that is worthwhile for them to take right now, a giant recouping of a loss, to go from 85 cents to 100 cents, we would make investors, and they have not disputed this math, and I've called them out to dispute the math, $1.4 billion would be made if these funds traded as well as their ETFs.
So you don't think that the investors in these funds actually want these funds to begin with? You believe that they've been effectively foisted on these investors?
Look, there's a mix. First of all, there's some sophisticated retail investors that buy the funds that we buy, whether it's copying us or on their own. There are investors that bought it at IPO, and then it's been passed on to them from their descendants. And a lot of these investors who buys high-fee closed-end funds at IPO, the least sophisticated investors, and all we want is to have a fair vote. Now, the thing that will shock is that the vote that BlackRock will take next month is to count people who don't vote as if they were BlackRock votes. And that's the thing that they're doing in this election that makes my head explode. But they would never dare do that for BLK stock. They're treating their shareholders in their stock versus their shareholders in their closed-end fund stock like second-class citizens compared to BLK.
Okay. The critics say the following, and so I'll ask you. You have done this before with several other funds. They're Republican now, GIM and Saba among them. Those trade at a discount, too, even today, and you're in control of them.
Right.
So what do you say about that? If yours are not necessarily performing that much better than theirs?
Right. So firstly, the critics are a lobbying group called ICI that works for the managers. Second, our fund, which was when we took over 3 years ago, the ticker is BRW. People can go to the website and see the letter we wrote. In 2022, the year after we took it over, we were the #1 performing income closed-end fund out of 257 funds. So they can say what they want. Now, to the question of the discount, okay? Right. Good question, right? Tough. That's a hardball question for me. In GIM and in PPR, which became Saba funds, BRW and SABA, we offered investors first a 70% tender, which not even 70% of the shares tendered. We got management to do that. We took it over, and then we offered a 30 tender and then a 15 tender. We offered more than 100% of the shares to be bought back if anyone wanted to.
Meaning investors could get out if they wanted.
At net asset value is the point, or right at asset value. And the investors, some of them did, and some of them said, we want to be with you. We want what you are changing this fund into. And that fund, I'm proud to say, has actually outperformed all of these BlackRock funds by somewhere between 19 and 64%. So let them take shots at my fund.
Okay.
But yes, they are at small discounts. That's true.
Maybe also hardball. have you lowered the fees on those funds since they became yours?
So one of them is already a very low fee fund. It's only 75 basis points. What we have done is set in place governance. We changed the governance to be best in class.
Right.
The elections are held annually. The votes are counted on how many votes you get, not the non-voters counting against you. And more than that, the managers of closed-end funds, this is something that's probably not well understood. They charge fees on what's called managed assets.
Right.
So if they lever up, you pay more fees. Now, when you invest in my hedge fund, if I want to lever up or lever down, it's the same management fee. So for my funds, I have not been running it at full leverage. I've been waiting for there to be an opportunity. We lever up. We don't like it, we lever down, and we're not maximizing fees. These other BlackRock funds are always fully levered.
Okay, I'm going to try one more on you. Okay,
Please.
this is the Ohio Sentinel Tribune op-ed in January. I'm sure you've read it. It says 3 years ago, a hedge fund firm took over a closed-end fund. They changed the investment strategy from a reliable senior loan fund to a fund holding risky assets, including crypto. Worse yet, they liquidated their shares, leaving unwitting retirees holding the bag. The same playbook seems underway on another closed-end fund now. They're referring to this, a Blackstone story. This flies in the face of basic principles of the Investment Community Act, the current law that's intended to separate hedge fund billionaires and fund insiders from the rest of us and stops them from eating our investment lunch.
Right. So again, not a holder of the fund, but a pro-advocacy person putting that story in. So that fund that got into crypto, okay, that's the one I was talking about. First, we offered people an exit near net asset value. And so we gave them the gain that we're asking BlackRock to give to make this $1.4 billion. Then we asked for approval to change the mandate from a reliable loan fund, which was invested in single B junk loans, junk-rated loans, and we got approval from ISS. 99% of the shareholders approved those words that you just said. We then invested, and we were the #1 fund in 2022. So that's what I have to say about that.
You talked about talking to Rob Capito of BlackRock a long time ago, 7 years ago. Mm-hmm. Have you ever called up Larry Fink about any of this? Does he take your call?
We don't know each other, and I'm perfectly happy to do so. If someone from BlackRock wants to send me his number, I'd be glad to, because if only he did it, it actually would be beautiful for his brand. His employees own these funds. They're rooting for the discount to go away. Who would not want this short-term gain? It's not short-term. We've been in these funds for years. What's the long-term pain? That you might have a smaller fund that BlackRock's managing, that you might have to go to one of a million other choices. $1.4 billion hangs in the balance. And as you know, Andrew, making money, unless you buy GameStop today, is really hard. $1.4 billion can be made literally if it became one of their ETFs or mutual funds, or if they did a tender. And
you've now started a website called Hey BlackRock, trying to get their attention. Trying to get their attention, or maybe trying to get the shareholders' attention. Really, the shareholders' attention. Hey BlackRock.com was set up because when you fill up your account at Schwab or Bank of America, you get asked, do you want to be contacted in these sorts of matters? And BlackRock is not giving us the names of the people who asked to be contacted, which is also unusual. So we have to get the word out, whether it's talking to you on Twitter or heyblackrock.com, where we are going to hold a webinar on the 20th, take investor questions, and go through the plan. While we have you here, you mentioned GameStop. We've been following that story this morning, and you play in the markets every single day. I see your whole the whole trading floor that way. People can't see it on camera. What do you make of what is happening right now in the markets, and specifically, actually, when you look at a GameStop? I mean, you are an investor. Is this investing? It's bewildering because we want to make 10%. We want to make 15%. You see something that's up 100%. You don't know why. It feels great because it's up, not down, for those who have it. But it certainly, in some ways, you could say, makes a mockery of the challenge of investing, because it can't be justified on anything other than pure speculation. Why today? Why not $1 million a share? And so I look at it and I don't understand it, and I don't want any part of it. Is this different? We were talking recently on our air with Gary Gensler, and I mentioned the Trump SPAC, for example, which also seems to trade this way. You were involved in that SPAC early and then got out. So I ended up being one of the 5 largest holders of the Donald Trump Truth Social Trust, because I didn't buy it knowing that. I bought it when it was a SPAC, and then they decided to merge with that company. So, you know, at that point, the SPACs, which we actually had in the funds that you read that Ohio Sentinel piece about, were at a very attractive discount. They were T-bills in a box.
Then they decided to buy this Donald Trump Truth Social, and it went to the moon. And I, again, didn't want any part of it because it's a little bit of greater fool. If it's at 15, it can go to 16. If it's at 50, you feel badly that you sold it at 15, but it was at 9 a minute ago. And so I like when you have this supernormal gain in something to take chips off the table if I'm lucky enough to even be there.
From a governance perspective and market integrity perspective, given that that's part of what you're talking about here in the context of BlackRock, what do you think should happen? I mean, we had Jay Clayton on earlier, former head of the SEC, and we're talking about market manipulation and the like. Do you think there's something that should happen to the sort of memification of the markets?
I think it's very hard to put in place rules to say this gain is too much, the news doesn't justify that. I think it does feel like greater fool theory, but I'm not sure who's doing something wrong to someone else. Obviously, if there are people pumping it up, but I don't know anything about that. So I really don't have a view about it.
Separately, just you're someone who spends a lot of time both looking at arbitrage opportunities, but also looking at the broader markets and where things are, and I think looking also for cracks in it. Mm-hmm. Where are we in this market? Do you see cracks? Should we be worried? Are you bullish? Are you bearish? So
the market is foggy, right? We had six Fed cuts priced in just a few months ago. Now we have one. Maybe we're going to zero. The way things change, is inflation, has it been kicked? Are we going to have higher for longer? I think that there's a very heightened amount of uncertainty, even just take the geopolitical skirmishes / wars that we have. And so when you put all that together, higher for longer, which means higher interest rates, which may be great for the lender, but for the borrower is terrible, we are going to, I think, have a credit crunch in the next couple of years if things don't change. And even you take the 100 leading economists, they're pricing about a 35% chance of recession, a hard landing, yet the credit market, just look at corporate credit spreads, are almost at the lows of all time. And so I think that credit does not offer investors any kind of suitable margin of safety right now, corporate credit, that is.
So you just spend all of your cash in the equity world?
Well, we own 6 billion SPACs. I should have said that at the top. Sorry, not SPACs, closed-end funds. We used to have 6 billion SPACs.
Yep.
And then we're very involved in protecting pension and endowment portfolios from a sell-off using credit derivatives, which is my domain expertise.
When you look at just even over the next 12 months, we talk about this being an election year and the like, does that change anything?
It's huge. If Trump is elected, it's going to affect the relationship between equity and fixed income markets quite a bit because he seems to want the stock market to go up, promising across-the-board tax cuts. Who's going to pay for that? So more debt, higher interest rates. And I would say Trump is likely to lead to more volatility, all things equal, than Biden, although once the election, maybe in both cases there's going to be plenty of volatility, and I'm quite excited for it.
You're quite excited for it. Finally, just on the timing of this whole BlackRock situation, what is the next step in it?
Yeah, so we've sued them again, first successfully last year in federal court for not letting us vote all our shares. This year it's for not counting the votes properly, for basically saying anyone who doesn't vote counts for BlackRock. That suit is going to get some resolution, and then we'll see how the votes will end up being counted. The voting will be done between now and, depending on the fund, July 3rd is when it all is over.
Okay, Boaz Weinstein, thank you for joining us this morning and having us right here this morning to talk about this. Thank you.
Thank you, Andrew.
Appreciate it. Becky, back to you.
Andrew, that was fascinating. Every aspect of it. One very quick question. I don't know if you can answer this. He was saying his fees on his fund are very low at 75 basis points. What are the fees that they're talking about on some of these Blackstone funds? Or BlackRock funds, I'm sorry.
You can't hear Becky, but one of the questions she was just asking, and she was fascinated by the conversation, was on the fees, and we're talking about 75 basis points, what are the fees that Blackstone has on its funds?
So BlackRock funds,
I'm sorry, not Blackstone, BlackRock.
Yeah. So one of mine is 75, one is 1%. Theirs are more like 1.1 range, but their ETFs are about half of that. So if someone went from a ESG closed-end fund run by BlackRock to an ESG open-ended fund run by BlackRock, they would be getting a very similar portfolio, same level of care, and they would save about half the fees.
How important is it for you to ultimately control the funds versus for them simply to shift and do what you want them to do?
Shifting would be massive. In fact, of the 60 or so campaigns, we only ended up running the funds twice. What we want is for shareholders, which we are the largest of, but not in any way the majority, to make that $1.4 billion, which can be done at the press of a button, and they have not disputed that ETFs and mutual funds trade at NAV, tenders at NAV, allow you to get out at NAV, $1.4 billion to their shareholders, and a lot of good brand image from having done so.
Boaz Weinstein, thank you.